What's going on, guys? Welcome to the Academy, as I told you guys in the first video. And in this specific video, I kind of want to talk about who I am. The teacher, the educator, the mentor, the instructor, everything to this academy. And chances are, if you are in my academy, you've seen a lot of my YouTube videos, you know about my story, but I feel for those people, like the rare few who don't know who I am and they just know I'm a good, trader, here it goes. So me, about 5, 6 years ago, when I was in college, I really had no money, and I was in the cafeteria. Like I said, I remember this like it was yesterday. In the cafeteria, watching a battle rap on my phone, and before the battle rap came on, a YouTube ad came on. It was this guy, talking about how he lives and what he does for a living, and having mentors and all of that extra stuff. And instead of me skipping the ad and watching the battle rap, I was broke. I had nothing to lose. So I just watched the whole ad, clicked the program, and basically what you guys did just now, I bought a course, and that course changed my life because obviously 5, 6 years later, I'm here. And in that course, all it did was teach me, like the mindset of the richest people in the world and what to invest in and, how to start thinking and how to save your money, budget your money, all of that extra stuff. That led me to start researching what to invest in and what to trade. And then obviously Forex came up and stocks came up and all the other markets came up. And I ended up, being more so into currencies more so than the others. All through 2015, I studied, man. I studied my ass off, man. I mean, like, once I got a hold of the market, I felt the same way you guys are doing. I'm gonna quit my job in 3 months. And I didn't have a job because I was playing college basketball, but like, I was doing like little freelance work. And I was like, you know what, I'm gonna stop doing this. I'm about to put my all into this. And then obviously after about 2 weeks, that honeymoon phase comes down and you realize this is a real life market. This is not a market you can just come in and play around with. You have to really give your all. And for me, I was like, all right, I know this market. After 3 weeks, I'm going in on a live account. And when I tell you I blew account after account, I probably blew about 15 live accounts probably. And when I say blow an account, it means deposit 300, lose all of it, go to zero. Deposit 500, lose all of it, go to zero. Deposit 100, lose all of it, go to zero. And the reason I was losing money is because I was so fixated on making so much of it that the more you chase something, especially with this market, the more you're gonna lose. It's like, I say this all the time on my YouTube, you come into this market, you realize this is one of the only jobs in the world where there's no cap on how much money you can make. There's no limit on how much money you can make. So knowing that, you start rushing the process and like, you know what, within a month, I'm gonna go on a live account. And you skip the process. There's a video in this series that says skipping the process causes disaster, and it's exactly true. It's because you think you know everything. You haven't even spent an hour learning this market for your entire life, and now all of a sudden at 22 years old or 30 years old or 35 years old or 25 years old, you think within a few weeks you're going to be a master at it when people have dedicated years to this. Like, I'm 5, 6 years in, and you guys are watching me now and trying to learn from me. But if I was 2 years in, you guys couldn't learn from me. Like, you guys can learn some things from me, but you guys couldn't learn how to trade from me because I wasn't profitable 2 years in. When I mean wasn't profitable, yeah, I was making $1,000 a month and $2,000 a month. Even in my 3rd year before I got on reality TV, I was making $3,000 a month, $4,000 a month, but I wasn't making crazy money. Like, I wasn't making all these profits you see me posting on my story and on my highlights and on my Snapchat. I wasn't making that in my 3rd year, my 2nd year. Now again, like, I had distractions. Like, my dad died. I had a ex-girlfriend I fought with all the time. I was playing college basketball, but like, there's really no excuse. And I'm just giving you guys a heads up on my story. It took me a while, but over time, I'm one of those rare people who just didn't quit. They say 90% of traders fails because 90% of traders quit. They come into this market knowing there's so much money you can make in it, and then they quit within a few months because they realize how hard it is. And it's not that hard the more you get into it, but when you see all the information, it may be overwhelming, and I get it, which is why I implore you guys to really go through all 4 of these series at your own pace. That does not mean stay up all night and watch my videos. No. That means watch 2 videos a day and then study them. Take the quizzes, download the PDFs, make sure it's ingrained in your brain before you try to move on to another section. This is series 2. Like, obviously I have 4 series, but everybody who's been in my old academy, this is, SWAGGY Academy 2.0, because I already had an academy. And this is, the 2nd series of just a whole bunch of new videos and new content. And if you binge, it's just like Netflix. You binge a bunch of content, you gotta wait months before we put out new content. So I'd rather you study and take your time and learn all the information and then go into a live account just like I did. I'm trying to save you guys some years. If you guys try to skip the process and go through all my videos in a day or two and upgrade and then go through all those videos in a day and then jump on a live account, you're not gonna understand. You're gonna be hitting me up saying I still don't understand it. But the more time you take and study and get more precise with your entries, more precise understanding technical analysis, and don't just blow fundamentals out the water, because we get into fundamentals and taxes heavy. Like, this is the place to be if you want to know everything about taxes and Forex and fundamentals, and that's obviously in series 4. So I really appreciate you guys for joining the academy, but know something about me and take something from my experiences. I was broke, and for the first 2-3 years, I tried to skip the process so much by trying to make so much money in a live account that I kept blowing it. It wasn't until I studied an entire, a few books on Forex, courses, and I studied all of it and did a demo account for a few months. That was when I started to see consistency in the market, when I wasn't attached to the outcome. So last thing I'll say is, don't be so attached that you're like, all right, I'm gonna quit my job in 2 months. Do not quit your 9 to 5. You need your 9 to 5 to fund, all of your Forex accounts until you get consistent. Once you have a consistent track record over a few months, yeah, cool. Quit your 9 to 5, do what you want to do. Use that money to, start your other side business, whatever. Cool, great. The goal, obviously, is after a few years to quit your 9 to 5. But if you think you're going to come in here and quit your 9 to 5 after a month, that's not how it is. You guys have to enjoy your job, enjoy your freelancing, enjoy the process. Because I didn't get here after a few months of hard work. I need you guys to think of the long game of Forex. I don't even know how long this video is, Austin. How long is this?
7 minutes.
7, wow, I was planning on doing 5, but I'm getting into it. Guys, please listen to me. I'm trying to save you guys some time. Do not skip the process. You guys are fine. I don't even want this video B-roll. Just let him talk to me. You know what I mean? Just let me talk to him. Don't skip the process, guys. Take what I'm saying to heart. And I swear you'll be profitable a lot faster. You may be profitable within 1.5 years and 2 years because you listen to me. But if you don't listen to me, it will take you a lot longer, as long as it took me, because I didn't listen. So I will see you guys in the next video. Enjoy series 1 of the academy. And in my next video, I outline the objectives and my actual goals for you guys with this course. Love you guys. Guys, welcome to the Swag Academy. In this video, I want to pinpoint some of the objectives that I'm going to try to help you guys with over the next 3 to 4 series. As you all know, in the Meet Your Instructor videos and the Welcome to the Course, I am Swaggy C. I am your trader. You guys know my story already, so there's no need to say it again. But what needs to be said is my objective for you guys. You guys are coming into this market either naked, meaning you have never done anything like this before in your life, or with some skin in the game where it's like you've been doing it for some time, but you're just not profitable yet. Or you're semi-profitable, but you just want to go to that next step, that next level, that next tier. You know what I mean? I'm here to help you get to all of that. My goal for you guys, and my only simple goal, is just to provide an extra income for you guys. Help you guys, get that extra income that you guys are deserving of. Whether it's an extra $2,000 a month that can change your life, or $5,000 or even $10,000. My goal is to help you get there. Now, it may take some time. It is going to be a journey. It's going to be a long, long road. I'm telling you. It took me 4 to 5 years to get to the point where I am right now. I was making a little bit, like I said in my Meet Your Instructor videos, a few hundred here and there, but I wasn't making the money, I am right now, just in general. You know what I mean? My goal is to really, really help you guys learn how to trade, but also better your life as a person in general. When you go on this journey learning how to trade, you come across different mindsets and abandoning the 9 to 5, route if you hate it, and how college is a tool that can be used and it should be used, but it's not necessary and it's not a prerequisite for success. And my main goal for you guys, aside from helping you guys, get that extra income that you guys so, deservingly I don't know if I even said that right. What's the word, Austin? That they deserve, right? Yeah, that they deserve. You guys deserve it. You know what I'm saying? Not just that, but also help you guys, you know, have the mindset that I have. I talk to people all the time. When I give them like a book to read, like whether it's Rich Dad, Poor Dad, or The Richest Man in Babylon, or the 10X Rule, any of that, and they've never been introduced to like this style of thinking, it changes their lives. It gives them hope on what they can accomplish in the future. I'm telling you right now, if you guys stick it out and don't look at this as some, within a month, I'm gonna be live trading. Within a month, I'm gonna be profitable. Within a month, I'm gonna be making $5,000 a month. You guys will be successful if you guys don't think that way. Look at it as, I will do whatever it takes to be successful in this market. I will emulate Swaggy. I will emulate his traders. I will emulate like all of their thinking. And then whenever I feel comfortable, not my desires and me rushing, but whenever I really feel comfortable, then I will join a live account and I will start small. In the course, in series 1, series 2, series 3, and series 4, I go over, you need to reward yourself. You need to have actual goals and understand what's your why. Why are you doing certain things? Why are you even here right now? Are you doing it just to get, you know, try to get rich in 2 months? This is not a get rich quick scheme. Are you doing it because you don't know what you want to do in life and you're hoping this can be it? That is a thing. I did that at 19. I didn't know what I wanted to do in life, and I came across this and I grew to love it. But I want to let you guys know that you have to love it at some point. You give it 3 months and you find yourself constantly thinking about it, you know you love it. If you give it 3 months and you're just like, I'm just doing anything that, you know, that I can do at this point, this really isn't the, you know, the route you should take. Long story short, series 1 comes with, you know, a complete intro to, you know, the market, to get you guys acclimated with this Forex market, teaches you the differences between Forex and the other markets, tells you what technical analysis is and fundamental analysis and all that good stuff. Series 2 goes into intraday trading, risk management, psychology, pairs to trade. Series 3 goes into scalping, swing trading, more risk management and psychology, more advanced tips. And series 4 is like the end all be all. We talk about taxes and brokers and trading and the banks and institutional trading and all that extra stuff. So one by one, go through all the series. And again, I hope to see you guys at the end at series 4. Hopefully me and Austin can give those who complete all 4 series a certificate or something. Or, you know what I mean, Austin? Something dope to show our appreciation for them. Even fund one of their accounts as a thank you for going through all 4 series. Me and Austin are, you know, deliberately planning on how to reward you guys for taking this next step in, you know, in your lives. So I love you guys. I can't wait to, you know, follow you along on your newfound journey. And remember, it is a long game. And once you look at it as that, you will become very, very successful. Last thing, my objective is to get you guys on the same mindset as me and to help you guys achieve that extra income. I love you guys. Hey guys, welcome to video 1 in the beginner's elevation section. It's titled, What is Forex? So obviously if you're watching this video, you have no idea what the foreign exchange market is. I have a video that I made last year when I had crazy hair and it's like, you know, B-rolled out. And I'm gonna, you know, incorporate that inside of this video. Everything else in my academy is all brand new content, but I feel like I explained the, you know, the topic of the foreign exchange market really well in that video. So, you guys are going to see that video and understand everything there is to know about the Forex market, and I will see you guys after the video. Yo, gang here. All right, I'm gonna get straight to the point because I know a lot of y'all clicked my video to know exactly what Forex is. And I basically made a tweet yesterday explaining how great the Forex market is, and I got a lot of replies, Instagram DMs and Twitter DMs saying, make a video, make a video, make a video. So guess what I'm doing? I'm here making a video explaining what the Forex market is. Basically, there's a bunch of markets in the world. Stock market, the Forex market, options, futures, commodities, real estate, cryptos, anything. Like there's a bunch of markets in the world. Guess which one I trade? Forex and cryptos. What's the Forex market? scratch facts. It's basically a big market that allows you to exchange one currency for another. And it's exactly what it is, currency. Forex stands for foreign exchange. Let me break it down in simpler terms. Basically, if you're traveling to, let's say, the UK, you have $1,000. You can't bring $1,000 to the UK. They have the pound. So when you're in the airport, you gotta go to one of those little counters that say Forex on the top. And basically, you give your $1,000 for the UK's version of $1,000 in pound money, right? Cool. Let's say you go to the UK and you're there for like 5-6 months and you don't spend a single dime. And I'm exaggerating because obviously you can't live anywhere without spending money. But let's say you don't spend a single dime and you travel back to the US and you have that same exact money you got 5-6 months ago and you try to exchange it back for US dollars. You may think you're gonna get $1,000 back. You are wrong. You're probably gonna get $800 back, $900 back, $1,200, $1,300, $1,500. Like, you're gonna get either less or more. And that's all because of the exchange rates. The exchange rates fluctuate constantly. Now, that's not how you make your money. Now, how you make your money, you're basically speculating on the exchange rates on one economy versus the next. Sounds confusing? Don't worry. I'm gonna keep breaking it down smaller. And by the end of this video, you're gonna understand it all completely. So what is traded in Forex? Money, literally that, currency. For example, you see a Forex contract or a quote that says Euro/USD and the price is like 1.13000. That basically means to get €1, you need $1.13. Make sense? Cool. Now, you make money in the market basically by saying, okay, based on Euro's economy and the technical analysis that I see on the charts, I'll get into chart work later. I basically think the euro is gonna rise against the US dollar. That's basically what it is. You're comparing two economies against each other. And whatever economy you think is gonna be stronger, you basically buy that country's currency. If you think it's gonna be weaker, you basically sell that country's currency. Now, how do you know what to buy and sell? That's a good question. Simple. Naysayers call it betting or gambling, and it's really not. It's literally day trading. People may think, oh, day trading in the stock market is gambling, because you never know when a company's gonna go up or down, or day trading in the Forex market is gambling, because you never know which currency is going to be better than another currency, and like, it's all lies. So gambling and betting are kind of one and the same for me. So basically, if you go to Vegas and you're like playing, like, let's say a dice game, and you're like rolling dice and you're throwing them on the ground, there's no signs as to it landing on a 7 or 11 or 5 or 6 or 1 or whatever you want it to land on. Basically 7-11 in terms of dice games. With the stock market and the Forex market, there's so many clues to factor in why the Euro's economy is going to be better than United States economy, or vice versa. There's technical analysis, which is basically looking at a chart. All the charts you guys see, yeah, those charts are not intimidating. They're actually very easy if you sit down and study them. The charts you see, they leave patterns. So for example, like if you see 3 green candles and 1 red candle, like that's a pattern. If you see a big red candle and then like a small candle, then another green candle, it's a pattern. Like, there's patterns that tell you, okay, if you see this pattern, that means you should buy because it's about to go up. If you see this pattern, that means you should sell because it's about to go down. That's technical analysis, using the historical price action from the past to determine where it's gonna go in the future. There's also this thing called fundamental analysis. Now, fundamental analysis basically means anything with the world, the government, the economy, the president, the Federal Reserve, monetary policy, raising interest rates, lowering interest rates, the unemployment rate, like anything to do with the world and the economy, like that's fundamental analysis. So you basically take in the technical analysis of things, like looking at the patterns of the charts, but you're also taking the fundamental analysis side of things of what's going on in the world. You put them together and you're basically saying, okay, based off the information that I have, the United States has to go up. The United States has to go down. So that's basically what it is in simpler terms. Who trades in the Forex market? Basically everybody. So at the top of the list is the biggest banks in the world. So basically Citi, JP Morgan, Barclays, then right under that is the large commercial companies. Then right under that is the central banks, I believe, that, you know, hold the reserves in the government. And then right under that is the speculators, basically us. We're called retail traders. So basically we're at the bottom of the list because we're individuals going up against banks and, you know, companies and stuff. So basically what I'm saying is, you making $30,000 in a month, or $50,000 in a month, or $5,000 in a day, or even a couple hundred in a day, a couple extra hundred, doesn't move the market at all. Remember what I told you, $5 trillion are traded daily. So us pulling money out the market, doing what we gotta do, trading, putting it in, putting it out, like, does not affect the market at all. Let me reiterate it. You gotta know what's going on in the world, because let's take GBP USD for example. That's the Great Britain pound versus the United States dollar. If all the signs in the world are pointing to the Great Britain pound rising against the US dollar, but the country wants to weaken its own currency. Yes, countries weaken their own currency. Then guess what? GDP USD is going down. You have to pay attention to what's going on in the world.
How big is the FX market?
People may think the stock market is the biggest. The stock market, the average daily trading volume of the stock market is 22.4 billion. Forex market is 5 trillion, like billion to trillion. The Forex market is here comparison to the stock market in terms of trading volume. Now, a quick history lesson basically on how the Forex market came about, and then I'm gonna transition it smoothly into how you can trade in the Forex market. So basically, at the end of World War II, there was so much chaos that all the Western governments felt the need to create a system to stabilize the global economy. So they created the Bretton Woods system, which basically put the United States dollar against gold. And what that means is, for all the dollar bills in the world, there had to be that much gold out there in the world somewhere. It wasn't too long where 1971, Richard Nixon took us right off of that. And in the past, it was only like what? Big speculators, like investment funds that were the only ones to be able to trade in the Forex market. But now, thanks to all the brokers we have and the internet and Wi-Fi and all the extra stuff, we're basically allowed to trade the market with not that much capital. You can open up an account with as little as $10 to as much as you want. 10 million, 2 million, 5 million, 1 million, like, you know what I mean? Like, I don't obviously suggest trading with $10 in your account because it's very hard to trade. Like, you're not gonna turn $10 into 10,000. Like, it's not how it works. You know, like, you have to deposit some money. My first account I started investing in was $250, I think. I put like $250 to a mentor and $250 to my actual account. I just grew it and grew it and grew it. Like, long story short, anybody can contact a broker, open up an account, deposit some money, and literally trade from the comfort of their own home. Like, I'm trading right now. Like, I have my chart popped up right here while I'm making this video. Like, so essentially how you actually make your money in the market is you basically have a lot size, and based on your lot size, depending on if it goes up or down, if you buy or sell, that's how much money you make. For example, let's say Euro USD is at 1.13000. If it goes from 1.13000 to 1.13100 and you had a 1.00 lot size, you just made $100. If it goes from 1.13000 to 1.13100 and you had a 0.50 lot size, you just made $50. And if it keeps going up, it's another 50, another 50, another 50, another 50, or another 100, another 100, another 100, or if you got an even higher lot size, another 200, another 200, another 200. That is how you make money in the market. You basically pick a lot size, and based on how many points or pips it moves, that's how much money you make. Now, the absolute best part about the Forex market and how you trade it and how it like connects to this 21st century lifestyle that we have, it protects us. It gives us so many options to protect ourselves. So basically, there's something called a stop loss and a take profit. What those two things mean is, if I'm ever losing this amount of money, get me the hell out. If I'm trading and I'm in an active trade right now, but I'm at the gym, I'm at a red carpet, or like for you guys, if you guys are at your 9-to-5 job while this Forex thing kicks off and you can't be on your phone at the time or your laptop, you can still place a trade and just put a stop loss and say, hey, I'm not gonna be monitoring my chart. If I ever am losing this amount of money, get me out. And guess what? You could be at the doctor or at the gym and you come check your phone and price got to that low point and it got you out and protected you. There's a thing called a take profit too. That means if I'm ever making this amount of money and I'm not on my phone, I do not want to miss it, because sometimes you'll be up $800 or $1,000 or $2,000, and guess what? You're not on your phone or your laptop. You're at the gym. You're with a girl. You're doing this, so you can't check your phone. And when you check your phone, you see that the market got you to $2,000 and you see it came back down to about 1,000, and like you're like, damn, I could have just made 2,000. Or it went down in a good way if you sold it to 1,500, but then it went back up, but you were selling the whole time, and now it's at like 800 and 500 and 400. Now you're losing money the more it goes up and up and up because you didn't set a take profit. Take profit basically means if I'm ever making this amount of money, get me out and get me my money ASAP. So it protects you in that way. Be careful of those high lot sizes because like they could wipe your account out fast. And I know we have stop losses to like protect ourselves from those things, but like your stop loss will get hit fast. Like the market moves, you know what I'm saying? So you gotta like be careful with the lot size you pick.
When should I trade Forex since it's 24/5?
There's specific times to trade. Like don't get anxious because it's 24/5 and like, I don't know what's the best time to trade. There's set times. Even though it's 24/5, does not mean you need to trade every second of the day, or you need to get anxious because you don't know what time to actually trade. There are different sessions in the Forex market, like a London session, a New York session, and an Asian, aka Tokyo session.
And based on those sessions and those trading times and like whatever you do in your real life with work or school or your life, whatever, you can base your trading schedule around those times. You don't have to monitor your chart 24/7 and be on it and be on it and be on it and be on it. No, like, don't worry, you won't miss a move. Just make sure you know what pairs you're trading, when they tend to move, what session they tend to move, and then base it around that. Now, this is why the Forex market is so cool, because people have this misconception that you have to keep your laptop right here and just like focus on the laptop all day and night. You have no social life, no nothing. Stop. Now, don't get me wrong. When you're first coming up in the market and you don't really know what you're doing, you're studying. Like, most of your days are spent studying and studying and studying. But once you actually know how to trade, your days aren't like stuck at a computer. Your days are basically, you know, spending maybe 30 minutes to an hour analyzing the market, figuring out what pairs you want to trade, and then trading them, and then going on with your day. Like from 3 to 4, maybe analyze your charts, figure out where you want to get in at. From 4 to 5, go to the gym. 5 to 6, read a book. 6 to 7, make breakfast, talk to your spouse. 7 to 8, do something, clean the house, go to your regular 9 to 5 job or your other hustle, whatever. Like, but constantly check your phone to see what the market is doing. How does that work? It's because I've already studied the pair. I already know my bias towards that pair. I already know I'm going to sell this pair or buy this pair. I already know what I'm going to do. So I'm going to place that trade and I'm going to walk away. Like, that's the biggest thing about trading, is like the robotic aspect. So to wrap it all up, the Forex market means foreign exchange. And what it is you're basically speculating on the exchange rates with one currency in their economy versus the next currency in their economy.
So I hope that explained Forex to you very, very well. And of course, you still have a bunch of questions, which is why we have a whole series called Series 1 for you guys to go through. And you guys will have, you know, better answers to your questions afterwards. So a quick breakdown of currency pairs that you will be studying. These will be your best friends over, you know, your entire trading journey. So there's a thing called major currency pairs. They all contain the US dollar, Euro/USD, USD/Japan, Great Britain/USD, USD/Switzerland, which is, you know, obviously CHF, Switzerland, USD/Canada, AUD, Australia/USD, United States, and New Zealand/United States. So these all contain the US dollar. Every single major contains the US dollar. That doesn't mean every pair that has the US dollar is a major, no. But every major company like Europe and Great Britain and Australia and New Zealand, that, you know, that's, you know, being compared to the US dollar, is considered a major, because about 85% of all transactions, all Forex transactions, contain the US dollar. Now, pairs that don't contain a US dollar are known as minors and cross-currency pairs. Euro/Switzerland, Euro/Great Britain, Euro/Canada, Euro/Japan, Great Britain/Japan, Australia/Japan, Great Britain/Australia. Like the three, you know, biggest countries, aside from China, obviously, but the three biggest, you know, trading countries aside from the US dollar is Europe, Great Britain, and I believe Japan. Those three: Europe, Great Britain, Japan are the three. So these, obviously, you'll see one in each of them. You have Great Britain here, Japan here, Japan here, Japan here, Europe, 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 Great Britain, Europe. So exotics like USD/Brazil or Thailand aren't traded at much, nearly anything at all. I don't know why I didn't put that there, forgive me, but nearly anything at all, they are barely traded. Their spread is insane. Like, it's not even close. And you'll get into spread later on, but they're rarely traded. How to read currency pairs. So if you open a chart and you see Euro USD equals 1.05650, all that means is just 1 euro equals $1.05 if you were to go to a plane and exchange money. So if you see Great Britain/United States equals 1.50422, that just means 1 Great Britain pound equals $1.50 cents in United States money. If you see something that says USD CAD equals 1.28050, that just means 1 United States dollar equals $1.28, obviously dollars in Canadian money. That's all it means. It's very simple. Like, these extra, numbers are called pips, which we get into in the understanding, the Forex language. It lets you know, basically, when you get to the lesson, you'll understand it. But all these extra ones it's like when you're actually trading. If it goes up 1 to 23, 24, 25, 26, you'll make $1, $2, $3, $4, depending on your lot size. You know what I mean?
But that's all it is. But if you were to exchange your money, if you had a one Great British pound, they would give you $1.50. There's no such thing as $1.50 and 4.22. Like, you know what I mean? This is just for trading purposes. So I hope that this video helped you guys out a lot. And I will see you guys in the next section. This is very simple. I'm trying to get you guys to understand the majors and the minors. What's going on, guys? This video is very, very important. We got to understand the language of Forex. You can't be a trader if you don't understand what we're talking about. So a pip, as I've talked about in the what is Forex video, a pip means percentage in pip. So price moves from 1.0800 to 1.0801, price moved 1 pip. That should be very, very simple. Like I said, I talked about it in the what is Forex video. A video a few videos above this one, but I want to go over it again just a little bit. What is a lot size? A lot size is the number of currency units you'll buy or sell. So when you trade, you may put in a 0.5 lot size or a 1.00 lot size, and I elaborate on lot size at the end of this slideshow. Leverage, how you are able to trade with more money than you have. If you have a 50-to-1 leverage and you deposit $1,000 in your trading account, you can trade a position worth $50,000, obviously 50 times 1,000. Leverage can work for you and against you. We talk more about leverage and margin in the taxes mini course because it all ties together. So in the taxes mini course, if you get that separately or if you just get tier 4 in general, where it comes with it, we talk extensively about, leverage and margin and, the cap that the United States holds against its traders, whereas like countries like the UK don't have a higher cap than the US does because of their brokers there. So margin, borrow money, not physically from a broker in order to trade a pair. So if you have $1,000 in your account and wanted to trade a position worth 50,000, like we said in the last time, that would be 5% margin. Again, we talk more about this in the mini course. Like, you don't really need to, understand it now when you're learning. Just you need to get like the jargon in your head now. Once we start doing demo accounts and actual, small live accounts and then like a real live account, you need to understand leverage and margin in its entirety, in which we definitely get into it as the series goes on. So long and short. So if somebody says, they're going long, that just means they're buying. If somebody says they're going short, that just means they're selling. Same with bullish and bearish. If I say, euro is bullish right now, that means it is going up. If I say euro is bearish right now, that means the currency is dropping. All Forex quotes are quoted in 2 prices, the bid and the ask. The bid is the price at which your broker will buy the base currency in exchange for the quote currency. For example, if GBP USD reads 1.1812/15, the bid price, the first one, is 1.1812. Basically, you would sell 1 British pound for 1.1812 US dollars, basically $1.18. The ask is the price at which the broker will sell the base currency in exchange for the quote. If Euro USD reads 1.0812/15, the ask price, the second one, is 1.0815. You would buy 1 euro for basically 1.0815 US dollars. Now, you don't need to know that. Like, I don't want to bore you guys to death with that type of jargon. You don't need to know that at all. It can be a little bit confusing. What you do need to know is the difference, because you will see it on MetaTrader 4. Like, you'll see the bid and the ask on MT4. What's important is something called the spread. So the spread is the difference between the bid and the ask price. The spread is important in knowing because it helps you understand how much you'll be down when you first open a trade, aka paying a broker commission. For example, if GBP AUD is 1.8061/76, 76 being the ask, 61 being the bid, you subtract those two and you get 15. The spread is 15. Now, to figure out how much you owe the broker in commission, you multiply the spread, 15, times the lot size you're using. So let's say you're buying GA with the 1.00 lot size. $1 times 15, well, 1.00 lot size times 15 is $15. So the minute you open the trade, you'll be losing $15 because of the commission. Anything after that is pure profit. So if you make $900, MT4 will show that you made around $885. If you lose $900, MTV will show that you actually lost $915. Hope that makes sense for you guys. But like, when you open a trade, you will wonder why you are, automatically losing money. It's because of the commission. Mind you, the commission is always not that high. The spread is also not that high as well. I just threw out like a random number. Like, the spread is usually closer than that.
But also, if you're using a 1.00 lot size, it means you have a big enough account to handle that. So Forex is only traded in specific amounts called lots. We're elaborating a little bit on the lot sizes. Remember, it's the number of currency units you will buy and sell. It's similar to the bid and the ask, where it's not that important. What's important is the lot size, but I want to go over it really quick. The standard size for a lot is 100,000 units of a currency, 1.00 lot size. A mini lot size is 10,000 units of a currency, 0.10 lot size. A micro lot is 1,000 units of currency, 0.01 lot size. The only reason I'm telling you the currency units is because some brokers show the amount that way, while other brokers show the quantity in lots. Like they'll show 1.00 or 0.5 or 2.00, which is a lot easier. It's a lot easier. For example, if you use a 1.00 lot size, as I explained in the What is Forex video, that means every time price moves from 1.10000 to 1.10001, you'll get $1 because you got a 1.00 lot size. So if price moves from 1.10000 to 1.10100, you'll get $100. And price moves fast too. You'll see how price moves, like you'll see how fast it can move from 1.10 to 1.12. That's $2,000. Obviously with all those, zeros and like the decimal spots in between. So like I said, like just like the bid and the ask price, same with the actual, number of units. It's not that important to understand. It's good to understand just so you know like the jargon. If you see it, you're not, caught off guard. But all you really need to know is like the spread on what you're trading, because that's how much you're going to pay the broker commission for getting in, which is never really that much, and lot sizes, because when you're on MT4 placing the trade, it'll ask you what lot size do you want. Do you want to make $1 every time this goes up one? Do you want to make a penny? Do you want to make $2? And mind you, I'm saying $1 and $2 like it's no money. Like it moves fast, so like be careful placing $2 because it'll go from negative whatever you start off the trade with to like $2,000, $1,000, $800 really quick, because the market is so volatile. So you got to be careful on the lot size you're using, and we definitely elaborate that on as the series goes on. What's going on, guys? So there are 3 types of analysis when you're trading the market, and I want to go through all of them really quick. This is going to be a short video because there's only 3 of them, and it's real simple to understand. So technical, majority of traders trade this way. This is where traders can look at historical price movements and determine the current conditions of the market. So basically, everything we are going to talk about in the next section, which is, candlesticks and market patterns and support and resistance, trend lines, like all the things that you can just look on a chart and just use to figure out what price is going to do is considered technical analysis. 90% of the market is technical analysis. Fundamentals is everything news related. So Donald Trump tweeting, economics, political policies, everything, interest rates, everything. Now, fundamental affects stocks heavily, way more than it does currencies, but it still influences currencies in a big way. But news comes out, maybe once a week, once every 2 weeks. It's not like every single day something is coming out, fundamental wise. So that's a good note to keep in your mind. Sentiment is not as revered as technical and fundamental, but it's still one where it's basically each trader has their own opinion of the market. So to tie it all together, fundamentals help form the sentiment of traders, whereas technicals help us visualize it on an actual chart. So think of, technical and fundamental and sentiment analysis as like a 3-legged stool or a tricycle, you know what I mean? Like something that requires 3 legs. They all are just as important as the other. Even though we, trade technically and 90% of the market is made up of technicals, you'll understand, when you go later into the series, it could take one fundamental announcement to wipe out all the technicals you've been doing the last 2-3 weeks. Like fundamentals is not something to play with. Like there's a reason why it comes out once a week or once a month, like these major news, because when it comes out, it affects the market, and like the lasting effect lasts 2 or 3 weeks, where those next 2 or 3 weeks, you got to be on the right side of the trade. So they all are just as important as the other. So don't only become a technical trader and ignore fundamental analysis, and don't do the other way. You know what I mean? But understand that each trader has their own opinion of the market. So don't, like, when you're looking at the chart, you may think it's so easy, like everybody is going to be buying it. No, like there are a lot of people in the world who may be selling the pair that looks like a easy buy to you. So every trader has their own opinion of the market because they all have their own technicals. They all use different tools. Some use indicators, some don't. And we'll talk more about that as the series goes on. But I want you guys to go through each section and don't put so much of an emphasis on technicals and put the same amount of emphasis you're putting on technicals as you do fundamentals. Now, for series 1, it's majority technical because you have to start out knowing everything technical related. But as we go on with series 2, 3, and 4, we start talking in and diving in on these fundamental announcements and how important they really are to shape and visualize the technical side of things in the market. So I hope this video helped you guys, understand the 3 types of analysis that, occur with the market. And I will see you guys in the next video. Into the subject. I don't know when QuickTime Player is going to record, so you probably missed the first sentence I said. Just diving into a little bit deeper about trading sessions and what they entail and how you need to understand each session in order to better your own trading. First, the FX market is 24/5, meaning it is open 24 hours a day, 5 days a week. There are 2 days when it's closed. Friday to Saturday between 5 p.m., then obviously all day Saturday, and then from all day Saturday to about 5 p.m. New York time, so Eastern, on Sunday. So Friday at 5 it closes, Sunday at 5 it opens. Even though it's 24 hours, people aren't working 24 hours in their respective country. The city with the major financial hub in the relevant time zone is giving the session title during their business hours. Meaning, when it's 8 a.m. and obviously when it's 5 p.m. in New York, it's not 8 a.m. to 5 p.m. in London or Tokyo. So whenever normal business hours ensue in the actual countries, their session is held active. The major sessions in the world are New York, London, and Asian session. And obviously, we hear all the time about the Sydney session and all of that stuff, but the Sydney session, I refer to it as a minor session. It really has, not as much importance. So I kind of categorize, just the 3 major ones, which is New York, London, and Asian. So starting with Asian session. Asian session begins a few hours after the market resets, between 7 to 8 p.m. And we're doing all, New York time, Eastern Standard Time. So if you live in the UK, you live in another country, you live in California, just like I do, you try to put yourself in the mindset of New York time. Excuse me. Tokyo is the major financial capital of Asia. About 21% of all Forex transactions are done here. But it's not just Tokyo. That everybody thinks it's just Tokyo. No, it's Hong Kong, Sydney, Singapore are all the same. So just like I said, I don't put Sydney as its own session, as a major session. We just categorize it all, between the Asian session because it's all parts of Asia. So Japan is the world's 3rd largest Forex trading center as well because the yen is the 3rd most traded currency. But what you should really know is that liquidity may be thin, meaning there's not as much trading volume during the Asian session. Most activity occurs in the beginning of the session when economic news is released. So you'll see a lot of news from Australia, New Zealand, Japan, and other countries that are really affected by the Asian session that are announced. But you won't see too much price movement. Now, you will see in the later series, the pairs I trade, Asian session has been very, very good to me. It really depends on the pairs you trade. If you're trading Euro USD and, a bunch of United States pairs and, Great Britain pairs, you won't find too much volatility. You won't find any movement. It'll just be in a range, like a consolidation range between those sessions. So liquidity will be thin during the session, but it also depends on what you trade because if you trade New Zealand or you trade Japan or you even trade gold, then liquidity could be a lot higher. The London session, right after the Asian session, is the London session, starting around 2 to 3 a.m. New York time and lasts until about noon. Now, when London starts for the first 2 hours, 2-3 hours, there is an overlap with the Asian session and the London session, which can be very, very, liquid. London is looked at as the capital of Forex, between every place on the entire planet. London is looked at as the capital. Over 32% of all Forex transactions are carried out here. This is the most volatile session, period. It has very high liquidity. It slows down in the middle, obviously, because their regular 9 to 5, you go to lunch, midway in the day. So it does slow down a little bit, but then it picks back up towards the end because we're going to get into New York session in a second. But you'll see towards the second half of London session, the New York session starts, which causes an overlap. So London starts at 8 a.m. Eastern time, and the markets reset around 5 p.m. I didn't mean to put London, I meant New York. So excuse me. New York session starts around 8 a.m. and not London. So back to this section with the London session. So a lot of Great Britain pairs, Euro, like they will be they will move. Like they will move a lot during this time. So if you're an overnight trader, you're in luck because London session is very, very liquid. 85% of trades involve the US dollars. 85% involve the US dollars some way, somehow. There's very high liquidity during the overlapping period with London in this session as well. What you should know is that New York is the second most volatile session. So when you get the highest most volatile session, which is London, and the second highest, which is New York, and you combine them, which you do between 8 a.m. to about noon, when it's still the last few hours of London and the first few hours of New York, the market is very, very volatile. It's probably the most volatile it will be throughout the entire day. Most times, economic news involving the dollar are reported in the morning. There are a few times where news can be reported later in the day, such as FOMC. But most times in the morning, with NFP and a lot of, Canadian news, they are reported in the morning. But you don't got to worry about NFP, FOMC, or any of the fundamental news until we get, deeper in the series. I just want to kind of give you guys a breakdown on the trading session. So, like I usually say, do not trade the session that you just feel is the most volatile. Trade the session that works best with your schedule. If you work a job, then trade the session that, is on the outside of that job, that kind of, where you have time to be at home. If you're currently laid off or you're currently not working, then trade whatever session, fits your schedule. Like if you're not an early, morning person, then try to, do New York session and Asian session. Don't even worry about London. Like don't try to trade the session just because it's very volatile. Trade the session that works best for your life. For me, I trade Asian and London because they work best for me. I don't really trade New York session too much, but I do trade Asian and London because of the pairs I trade. I trade GBP AUD in gold and GBP USD. And like I said, you'll see it later in the series when I break down why I trade those pairs and why they became my favorite. But my favorite doesn't have to be everybody else's favorites. I've been backtracking them pairs for so long, so I know how they move already. So just figure out, how these sessions can benefit you and pick, a session or an hour, with the Asian session, an hour with London, depending on, who you are. You got to figure out who you are as a trader. Do you have kids? Do you have, people living with you, or are you living by yourself? Figure all that out, pick a trading session, and then obviously pick up the pairs that are most volatile with that session and then trade them. To talk about market open and the market reset. It's very important to know what happens when the market does reset and what happens when it opens. So let's start talking about it. So the market opens at Sunday at 5 p.m. EST, New York time, and closes on Friday at 5 p.m. EST. Every day at 5 p.m., the market resets. So if you hold the trade overnight past 5 p.m., you will either be charged or credited a rollover fee. So for example, if you're up $1,000 at 4:50 p.m. New York time and you didn't close yet, and you wait the 10 to 15 minutes till it gets to 501, 505, you'll either be charged $3 or $5 or $10 or 50 cents or credited that. The fee is calculated by the interest rate differential between the two currencies of the pair you're trading. It also depends on whether you're buying or selling. So here's a good example. If the European Central Bank has an interest rate of 3.00%, and the Federal Reserve, the US, has an interest rate of 2.25%, and you sell Euro USD, remember, when you're selling Euro USD, you're selling euros to buy the United States. You're technically buying US dollars, which has an interest rate of 2.25%. When the interest rate of the country you're buying is more than the interest rate of the country whose currency you're selling, your trading account will be credited. If it's the opposite, the reverse will happen. So in this scenario, we sold EU, which had an interest rate of 3.00%, and we bought the United States, who had an interest rate of 2.25%, meaning we would have been charged, I don't know, whatever percentage it may be. I know the math is the difference between it times this and all that extra stuff, but it wouldn't have been much. It probably would have been we've been charged 50 cents or $1 or something. But it's not to worry about. Like I said, it could be as small as 50 cents or even as high as $30, depending on what pair you're trading and what lot size you're using. Now, for the weekend, a similar situation can happen by holding your trades over the weekend, but it can also have way bigger consequences. What you guys need to understand, like holding a trade another day is different than holding a trade over the weekend. The world doesn't stop over the weekend. The market does. So when the market opens up on Sunday, it has to account for what happened over the weekend when the market was closed. So if you are holding a long trade such as GBP USD over the weekend, and on Saturday something major happens with Brexit, like just something major in general. On Sunday, once the market opens, GBP USD will tank, and your account will see the ramifications of holding your trades over the weekend. Meaning, if something crazy happened on Saturday and Sunday at 5 p.m. when the market opens, it's not like it'll wait 10 minutes or an hour and then drop. No, it'll open where it should be, where it would have dropped at. So look at my cursor right now, because I'm not on like the actual chart, but just look at my cursor right now. So if the market was right here on Friday, closed right here, and you're buying it, and then something happened on Saturday, on Sunday when the market opens, it's not going to open right here. It's going to open wherever it tanked at over the weekend, and there's going to be a huge gap right here. So we'll talk more about gaps in the later series, but it'll be a huge gap right here, which is why you got to be very careful with holding your trades over the weekend, because you don't know what can happen, obviously on Saturdays. Only swing traders should even think about holding their trades over the weekend. If you're a scalper, it's not even in your arsenal. And if you're an intraday trader, do not try and hold your trades over the weekend. I don't care how good your trade is doing on Friday. Close it, take your money, and recenter yourself on Sunday. If you're a swing trader, you can hold it, but just make sure you're aware of what fundamental announcements are coming out that Saturday so you don't get burned.